I'm Kyle with Fundamentals of Finance, and now that you've watched my primer on inflation and have a better understanding of what it is and what drives it, we can move on to how inflation impacts different types of investments. In this video, we'll explore some of its impacts on the bond market. The first thing and most basic thing you need to know is that inflation is generally not good for bonds. There are two reasons for this. First, usually when you buy a bond, aka loan someone money, they, or the bond, then pay you interest over time until a set maturity date at some point in the future. And then you get your original amount of money back. Remember, inflation measures how quickly things are getting more expensive, or put differently, how quickly the value of money is eroding. So if you buy a $1,000 bond that matures in 5 years, the higher inflation is, the less your $1,000 will be worth when you get it back at the end. The dollar amount will be the same, but the value may not. The second reason that inflation is bad for bonds is that it often leads to rising interest rates. This can also happen in two ways. First, as I explained in my first inflation video, the Fed often raises the Fed funds rate, or the rate that banks lend to each other overnight, in order to fight inflation. When that happens, other interest rates tend to rise as well, especially on short-term, high-quality bonds. Second, if higher inflation is expected to persist for a long time, then long-term bond yields will also typically rise. This happens because investors like you want to make money when they loan it out, aka buy a bond. If inflation is expected to be higher, yields will need to be higher to compensate for the fact that money won't be worth as much in the end. So in different ways, inflation can lead to both short-term and long-term interest rates rising. Why is that bad for bonds? This is a topic we'll explore in greater detail in a video dedicated to this topic, but for now, at a high level, it's the way bond pricing works. Imagine you own a US Treasury bond that matures in 2050 and pays you a coupon or interest rate of 2.5% per year. Then interest rates go up and new Treasury bonds maturing in 2050 now pay 3%. Why would anyone buy your bond from you when they can get an equivalent one that pays a higher interest rate? Well, they wouldn't, unless you lowered the price. I'm not gonna do the exact math right now, but the way the pricing shakes out is that your bond will fall in price the exact amount it needs to for the future return on your bond and the new bond to be equal. So on a new bond, someone would pay $1,000, get 3% interest along the way, and then get $1,000 back. On yours, they might pay, say, $900, get 2.5% along the way, and then get $1,000 back. So an investor might buy your bond instead of the new one because what they lose in interest, they make up for in appreciation, buying the bond for $900 and getting $1,000 back in the end. So if you own the first bond and you paid $1,000 for it, and then rates rose and the value went to $900, you would have lost $100. That is why rising rates are bad for bonds, and inflation is bad for bonds in part because it leads to rising rates. Remember, the other reason is that it erodes the value of money over time, and a bond usually gives you a fixed amount of money in the future. Now, as complicated as the financial markets are sometimes, you can probably imagine that not all bonds are created equal. We could spend hours unpacking every detail, and likely will over many videos in the coming years. But for now, let's touch on just two non-standard types of bonds to think about. First is high yield bonds. These are generally much riskier. You're loaning money to someone who might not pay it back, so they have higher yields. Rising rates don't have quite as much of an impact on these because they usually have a much higher yield than more conservative bonds like treasuries. For a simple example, let's say you have treasury bonds that yielded 2%, and you had a high quality corporate bond from an established company like McDonald's that was paying 2.5%, and then treasury rates went to 2.5%. Who would buy your McDonald's bond? Sure, it's probably pretty safe, but McDonald's can't raise taxes or print money, so the price would have to fall on the McDonald's bond. If instead you had a bond from a riskier company that was yielding 7%, and then treasury rates went up from 2 to 2.5%, you'd still be getting way more than a treasury bond. So interest rate changes don't matter as much for high yield bonds. The second category of bonds we'll talk about is TIPS, or Treasury Inflation Protected Securities. The mechanics of exactly how they work are probably too complicated for this video, but what you need to know is that they are a special kind of bond where your principal, or the value of your investment, adjusts upward based on inflation. These are designed to do better than treasury bonds in a rising inflation environment, and often do better than most other bonds in those environments. But there are a few caveats to consider. First, while they tend to do better than most other bonds, they are not guaranteed to make money. Remember, inflation tends to be bad for bonds because it often leads to rising rates. TIPS don't protect you against rising rates per se, but they protect against rising inflation, which is often the cause of rising rates. While TIPS are based on CPI, the common measure of inflation I discussed in the prior inflation video, the Fed's interest rate decisions are based on a different measure of inflation called PCE, or Personal Consumption Expenditure, which differs slightly, so the Fed's moves based on PCE and the TIPS price changes based on CPI may not always be perfectly synced up. As I'm writing this in April 2022, many people think the Fed is behind the curve and that they should have raised rates more than they have so far to combat inflation. This is just an example, not a market call, but if they were to begin catching up by raising rates a lot, and then inflation turned out not to be as high as it's currently expected to be, that could be a particularly bad environment for TIPS. So as a recap, inflation negatively impacts most bonds because it erodes the value of your future payments and it often leads to rising rates. However, some bonds are more impacted than others, and TIPS have historically been a fairly low-risk way to provide some protection against short-term rises in inflation, particularly relative to other types of bonds like treasuries. To protect against inflation in the long term, one of the best ways is actually to own equities, which is what we'll cover in our next video. If you really want to learn more about investing, please check out my free webinar below titled The 9 Habits of Successful Investors. The link is in the description. Thank you for watching, and if you learned something, please give this video a like and please subscribe and click the bell so you don't miss any investment videos from me. See you in the next video.